Gross income. What's the difference between gross income vs net income? The terms gross income and net income are both crucial in understanding personal finances, business finances, and tax filings. They represent two different levels of income, and understanding the distinction is key for budgeting, tax planning, and evaluating financial health. Here's a detailed breakdown of both terms. 1. Gross income. Gross income refers to the total amount of money earned before any deductions or taxes are taken out. It represents your income at its full value. Gross income can apply to both individuals and businesses but has slightly different meanings in each context. For individuals, personal income, gross income includes salary or wages, the amount you earn from your job before taxes or any deductions, like insurance, retirement savings, etc. Bonuses or commissions, any additional earnings you receive from your employer. Investment income, interest, dividends, and other earnings from investments. Rental income, money earned from renting property. Other sources of income, alimony, child support, freelance work, self-employment income, and other types of income that are not subject to deductions. In short, gross income for an individual is the total earnings before anything is deducted. For businesses, gross income, often called gross profit, is the revenue a business earns from its sales or services, minus the cost of goods sold, COGS. It does not include other expenses such as operating costs, taxes, or interest payments. Formula: gross income, gross profit, equals revenue, sales, cost of goods sold, COGS. This is an important figure for understanding how much money a company is making from its core operations, before factoring in other expenses. 2. Net income. Net income is the amount of money left over after all deductions, like taxes, business expenses, and other fees, are taken out. It's considered the bottom line because it shows the true, final earnings. For individuals, personal income, net income is what you actually take home after all taxes, retirement contributions, healthcare premiums, and other deductions have been subtracted from your gross income. Deductions may include federal, state, and local taxes, Social Security and Medicare taxes, insurance premiums, health, dental, life, retirement contributions, 401k, IRA, etc., other voluntary deductions, union dues, wage garnishments, etc. Formula: net income equals gross income, deductions. This is the income that's available for spending or saving after mandatory deductions have been made. Net income is often referred to as take-home pay or disposable income. For businesses, net income is the total profit after all expenses have been subtracted from total revenue. This includes operating expenses, taxes, interest, depreciation, and any other costs that the business incurs in the process of running its operations. Formula: net income equals revenue, cost of goods sold, COGS, operating expenses, taxes, other expenses. This is the final profit or loss that a company generates over a given period. It reflects the actual earnings that are available to the company's shareholders or owners, after accounting for all operating costs, interest, and taxes. Read the following table to review the key differences between gross income and net income. Examples to illustrate for individuals. 1. Gross income. Imagine you earn $5,000 per month from your job. You also make $200 from freelance work. Your gross income is 5,000, salary, plus 200, freelance, equals 5,200, so your gross income is $5,200. 2. Net income. Now, after deductions, let's say taxes, insurance, and retirement contributions total $1,200, your net income would be 5,200, gross income, 1,200, deductions, equals 4,000, so your net income, take-home pay, is $4,000. For businesses. 1. Gross income. A business earns $200,000 in revenue. The cost to produce the goods it sells is $120,000. The gross income or gross profit is 200,000, revenue, 120,000, COGS, equals 80,000, so the gross income is $80,000. 2. Net income. Now, subtracting operating expenses, $30,000, taxes, $10,000, and other costs, $5,000, the net income would be 80,000, gross income, 30,000, operating expenses, 10,000, taxes, 5,000, other costs, equals 35,000, so the net income is $35,000. Why are both important? Gross income helps you understand overall earnings. For individuals, it's useful for understanding your potential tax bracket and the total income you have to work with before deductions. For businesses, it indicates how much money is earned from core operations before factoring in costs like rent, salaries, or interest payments. Net income gives you a true sense of your financial health and available resources. For individuals, net income shows how much you can actually spend or save. For businesses, it shows whether they are operating profitably or not after all expenses are considered. In conclusion, gross income is your total earnings before any deductions, and net income is the amount you're left with after all necessary expenses have been subtracted. Both figures are essential for making informed financial decisions, whether you're planning your budget, evaluating the health of a business, or preparing for taxes.